With all the choppy price action currently going on with the US dollar recently, it's a good idea to discuss the typical signs that we can look for when evaluating when a medium term bias has changed, when that overall fundamental outlook has changed. Now, the very first and probably the most obvious clue that a medium term bias has changed is to evaluate whether the reason for the asset trending up or down in the first place has suddenly changed. So, if there was a specific positive or negative driver, did that driver suddenly change, or did something happen that makes that driver less important or not as impactful anymore? So in this case, think of a central bank that was expected to hike rates, and suddenly the bank or the central bank makes a 180-degree turn, and now suddenly the markets are pricing in a potential cut where they were pricing in a potential hike. That would be a very big change from a prior reason to expect a certain trending move, and then that suddenly changes. So if we take a look then at the dollar's medium-term downside bias, I mean, there's been a couple of factors driving the dollar lower from the latter part of 2020. We had ever increasing risk appetite across global macro markets, which was, of course, negative for the dollar from a purely safe haven point of view. But the biggest driver was the market's overall bets in a broad-based global synchronized recovery, where the US was actually expected to underperform the rest of the world by quite a bit. So has that changed? The second part we know has recently changed. If we quickly get that on the screen, the markets was pricing in a much lower growth for the US from the start of the year, just 2 shy months away, we can now see how the markets expectations for growth in the US has changed with the onset of that new fiscal stimulus bill, and the fact that the Democrats have taken a blue sweep victory, which obviously gave them the opportunity or increased probability to get that fiscal package of $1.9 trillion across the board. So we can see that from a pricing point of view, from an expectation point of view, the markets have really changed in that where the US was expected to be one of the major underperformers, they are now expected to be one of the major outperformers versus things like Europe, etc. Now, what makes this tricky is that the US has basically just caught up with the rest of the world. And yes, it has surpassed growth expectations for some major economies like Europe, but the idea of reflation, that expectation of seeing a broad-based, synchronized global recovery, which is usually dollar negative, that part has still not changed. So yes, even though there's a growing change in the relative growth and inflation dynamics, which is currently supporting or favoring the dollar, the reason why the dollar isn't higher just based on that alone right now is because everybody is expected to grow. Yes, there will be faster and some slower, but a global synchronized recovery nonetheless is still expected, and usually on balance that should be more dollar negative. Now, the second way, of course, of evaluating whether the medium-term trend for something has changed is to evaluate whether new incoming events or news or expectations or factors or drivers or catalysts has been impactful enough to change the medium-term outlook. Now, there are 2 very important recent drivers for the US dollar in the short term that we need to be aware of. Even though bond yields at the back end of the curve has been moving higher sharply globally, the move has been much faster and more severe on the US side, with US 10-year currently trading, as you guys know, close to 1.6%. And with already higher rates in the US compared to other places like Europe, for example, the massive increase in yield differential attractiveness recently for the dollar is something that has provided some meaningful upside. The other driver has been policy normalization. And if we just quickly get euro dollar futures on the chart for a second. There we go. So the one that we want to be looking at here is the September 2023 contract, which is the blue one. Now, from a policy normalization point of view, with that recent rise we've seen in yields, we've seen quite a big change in policy normalization expectations for the US, where the euro-dollar futures contracts, for example, they barely priced in just one rate hike, just 2 shy months away. Where right now, the current rate we're sitting in is actually implying just over 3 hikes for the Fed by September 2023. So we've seen a rapid increase in those policy expectations. Now, that is, of course, a major positive for the dollar. And if it was just on the US side, once again, it would have been more positive. But right now, there are a few central banks whose expectations for policy normalization has grown recently. We have the BOC of the Bank of Canada, as well as the RBNZ, Reserve Bank of New Zealand, who both are expected to taper asset purchases, not sometime next year, like the Fed, but actually sometime this year. And we also have a change in the BOE where the market was still pricing in the potential for a rate cut of 10 basis points by this time next year. And now the markets are pricing in actually a hike of 10 basis points by this time next year. So it's not just on the US side where policy normalization has been supportive. It's been supportive on many other major global economies or currencies as well. So are there, are these new factors and drivers, are they important for us to keep in mind? Yes, they are very important. Can they change the medium-term bias? Yes, eventually they can, but it's too early right now to make that conclusion based on the information that we have. Usually in these cases, markets will say that the price in the end will be the deciding factor, as in price will guide us whether that bias has changed if it just continues to move higher. And even though I do agree with that in some case or in some sense, we do need to realize that price alone doesn't necessarily change a trend. Right now we have a very oversubscribed short bet running on the US dollar from the end of last year. And when positioning is this stretched and the whole market is short or long on something, then the resulting squeeze, which can sometimes follow from that, can be quite violent. So even if we do see a massive upside move, arguably we've already seen some of that recently, that doesn't mean that the bias has changed. It might just be a squeeze playing out. And once that squeeze has played out, it's going to be we're going to be left with a much more fairer fight, more comparing apples with apples, so to speak. And at that time, we should have more data and more information available to guide our bias from there as well. So these are two very important tips that should help you to evaluate when a medium-term trend might be running into challenges, running out of steam, which might be just temporary, or when those drivers can actually be enough to change that overall fundamental outlook.